bid, 650.
Bid? Did you say bid?
Yeah, 650.
691.
Team C, 691.
All the students are going to be divided up into 5 groups. And every team is going to start off with $20 in cash and with 3 assets. And in each trading period, there's going to be an auction. And when a buyer and a seller both are willing to trade at the same price, then an asset actually trades. And then the very last thing that happens in the period is that my graduate student assistants are going to go around and they're going to roll the dice once for every asset. If it comes up 1, then that asset is destroyed. We're going to rip them in half.
Rip it up! Rip it up! Okay.
It's gone for the rest of the experiment. You know, you can think about a company going out of business. Eventually, as we get towards the end of the experiment, people will realize that the assets are overpriced. And when that happens, there'll be a big sell-off. In the real world, it's hard to know whether you actually have a bubble or not. Because in order to know that you have a bubble, you have to know what the real price of the asset is. So the advantage is I actually know what the price of the asset is they're going to be trading. So when it goes above that level, I know there's a bubble.
I think we were all just trying to win. So we were focused on trading assets and buying and selling instead of understanding what she was trying to make apparent, which is how we created the bubble. And so we figured we'll just try and kind of manipulate the market by bidding first and bidding low, and then everyone else will see what we're doing. So if we started bidding at 400, they'll bid at 450. So then the person who was just gonna ask for 800, now they're more likely to ask for like 650 and kind of meet us towards more of where the equilibrium was, and that didn't happen.
We're gonna ask for 720.
Okay, Team D asks 720.
One of the things that happens is that some of the students will lose a lot of money in this practice market. And one of my hopes is that once they've had the experience of losing money, even if it's not real money, in a market bubble, that they will become aware of the fact that bubbles can occur and that it'll help them in the future. You know, we always talk about active learning around the university, and this is really a way for students to be in the middle of the market that we're trying to help them study.